Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals with my weekly audio blog. It's Friday, April 11th at midday, and wow, is there a lot going on as the PPT desperately tries to stop an actual NASDAQ market crash a la 2000. I mean, we've already discussed how margin debt is twice the level that it was at the top in 2000. And of course, we see the quality of IPOs that are coming out, that came out. King Digital, the maker of Candy Crush. And of course, last night, Ally Financial, i.e., the former General Motors Acceptance Corporation, which epitomized the subprime crisis, somehow went public. Will they be able to staunch off the reality of 2000 like valuations amidst an economy that's about a thousandth of the strength of the 2000 economy and no retail participation? We will see. Of course, it's going to take a lot of printed money just to prevent that from happening. Now, I'm not sure how loudly we can scream of how catastrophic the last 5 years of maniacal money printing have been. The fact that Jamie Dimon of JP Morgan quoted Martin Luther King Jr., of all people, in his annual shareholder letter this week is just icing on the cake of a world so disgustingly corrupted by lies, deception, and criminality, it barely resembles what anyone alive can remember. Yes, Jamie, the arc of the moral universe is long, and yes, it does bend toward justice. Unfortunately, economic justice requires the collapse of the global fiat currency regime that your company, JP Morgan, has spent the past century fostering for the benefit of the 1% at the expense of all others. This time around, as I wrote this morning, the new 1% will be those holding real money, that is gold and silver, while all others run the risk of losing everything they have worked for. Ask the people of Zimbabwe 10 years ago, or how about Venezuela today, if you don't believe me? Or for that matter, the Ukraine. How about the Arab Spring nations, which spend the greatest percentage of their incomes on food? And of course, the Fragile Five, where a quarter of the world's population live, and ultimately Japan, which I think will be the first modern economy to go into hyperinflation this century, Europe, and ultimately the world superpower, which for the time being still possesses the world's reserve currency. And if you see what's going on with all these Russian and Chinese deals being signed, it's not long before that status is gone. I could speak for an hour today, but don't have the time. Let's just say the ongoing tech crash and global economic implosion, as characterized by the 50% plunge in the Baltic Dry Index this year already, may well be the beginning of the end, providing the straw that finally catalyzes Whirlybird Janet to commence the endgame of fiat currency collapse by admitting that tapering is a sham and actually increasing QE to new unprecedented levels. I mentioned the Candy Crush and Ally Financial IPOs as the epitome of financial insanity. And now that we're seeing, look at Wells Fargo's earnings this morning, and you see about how their pace of mortgage origination is doing, and you realize that the housing bubble was created completely by Wall Street as well, and you realize how close we are to that end. Now, last week's audio blog was titled "The Calm Before the QE Storm," and frankly, even I didn't expect us to leave the eye of the storm so quickly, as global financial markets have plunged this week. Sometime later this year, perhaps sooner rather than later, I fully anticipate a hyperinflationary confluence of events on a worldwide basis, including new QE announcements from the Bank of Japan, the ECB possibly within the next month or two, and for the coup de grace, of course, the Fed, when Janet Yellen finally admits she's no better than Ben Bernanke and Alan Greenspan before her. The PBOC in China will continue to print quietly. They don't come out with QE programs, but it doesn't take a rocket scientist to realize that their shadow banking crash is gaining serious momentum. And now that they overtly stated it's no longer in China's interest to continue acquiring foreign exchange reserves, You can bet they'll be selling all the paper assets not nailed down, while simultaneously buying every ounce of gold and silver, every barrel of oil, and every bushel of wheat and corn they can get their hands on. I mean, look at food prices literally exploding. Can you imagine watching stock prices plunging while oil prices are hitting new highs? Well, that's exactly what's going on. It's called stagflation. And again, it's not just about money printing when it comes to resources. It has to do with the end of the low-hanging fruit. Shale fracking is not going to end the oil crisis, and certainly suppressing the price of gold is not going to end the gold prices. But even before that, the ability to get gold out of the ground and oil out of the ground has been increasingly expensive for decades. The age of paper wealth is in its dying days, and when the inevitable 2008 Part 2 commences, the hyperinflationary response the world's governments and central banks will take will be historic and world-changing, all for the worse, of course. This week I wrote an article titled, "What Will It Take to Prevent a 2008 Redux?" The answer, of course, is it cannot be prevented. However, you can bet the Fed will lead a money printing charge that will make 2008 and 2011 look like nothing, and with it the commencement of global hyperinflationary fears that ultimately torpedoes what's left of confidence in fiat currencies. I've spoken for some time of the misnomer, or better put, propaganda, that we are going through an emerging market crisis. No, all currencies are falling against the dollar, as without the reserve currency, accelerated money printing, which is occurring everywhere, causes more inflation in the less liquid, less widely used currencies. Meanwhile, the dollar has plunged against items of real value, like food and energy. I mean, my God, U.S. food prices are up 20% this year alone. You think it's a coincidence that that's occurring, or that we're seeing record gasoline prices for this time of year? I mean, we're close to the record highs from 2008, and we're not even in the driving season yet. Not to mention that our gasoline prices are so high despite this so-called fracking revolution here, and a miserable economy in which the numbers show that demand for actual gasoline has plunged in the last 5 years. And as I wrote in the piece, Mother Nature's had enough, it shows also in the number of flights which have plunged in the past 5 years. So the point is, you're seeing less demand in the economy, so-called improved production methods, and yet record high oil and gas prices. Something's wrong, huh? These are trends that don't turn around, that's for sure. And then when you throw in things like catastrophic droughts in California and Brazil, it just magnifies the effect of markets that are already hyper tight. I mean, there's a lot of people around, and there's not a lot less resources than it used to be. I wrote an article a year ago or so called "Population Growth Supersedes All," and I think some people might have taken offense, thinking, well, where people are innovative, there's more people, we'll just figure out more ways to get things out of the ground. Yes, we will be more innovative, but the fact is, we may not have reached peak oil, but we've certainly reached peak cheap oil. And the more people that are around, the faster we reach the peak cheap oil, and the faster that peak cheap oil floor rises, as is the case for oil, for gold, for copper, you name it, wheat, and particularly the food, of course, which is the most important commodity of all. This week we saw utterly abysmal economic data across the world, starting in Japan, of course, where 1 week into its suicidal increase in the national sales tax from 5% to 8%, and remember next year it goes up to 10%, its largest department store chain, okay, drum roll please, reported a 25% in sales. No, not a typo, it's 25%. And actually a reader of mine in Japan sent me an article today showing that electronic sales are down 30 to 40% in the past week. And that, remember, sales plunged before the tax increase. Okay, which is crazy because last time they raised sales tax back in 2006 or 7, they had a huge increase before the tax increase, which you would think people would do to save money. But the fact is they're plunging so much, their economy, that it actually fell beforehand, and now it's free falling. In fact, the Japanese trade deficit, and they've never had a trade deficit, It's now free falling like Lehman Brothers stock, as is Shinzo Abe's approval rating, by the way, hitting a new all-time low as we celebrate the first year of Abenomics, watching the Nikkei in free fall as well. Again, I continue to believe Japan will be the first world nation to experience hyperinflation in the 21st century, perhaps even as early as next year. Now in China, the list of shadow banking defaults is starting to rapidly pile up. And given that the PBOC couldn't possibly bail out thousands of private entities, as opposed to the Fed, which simply consolidated a handful of middle-sized lenders into too-big-to-fail behemoths, the PBOC's response will simply be to print money, mostly covertly, and devalue the yen further. China's gold demand has started the year well ahead of last year's record pace and will only explode as the year moves on. However, that gold won't save it from all that fiat collapse beforehand, as not until the dust settles after the entire global fiat currency regime is destroyed will such gold enable the new yuan to rise from the ashes. The new 1%, as I mentioned before, holding physical gold and silver, have the best chance of surviving the upcoming economic cataclysm. But for everyone else, including hundreds of millions of Chinese, entire fortunes will be lost. In Europe, the pressure on Goldman Mario Draghi to face his reckoning day, as I wrote a few weeks ago, and initiate the OMT QE program grows stronger each day. I mean, God, today we saw Jack Lew and Christine Lagarde calling for it. Last week we learned that the ECB, supported by its most hawkish member, with quotes around it, the German Bundesbank, has modeled a $1.4 trillion QE program. I would be shocked if they don't reduce their benchmark interest rate by that last 0.25% by mid-year. And frankly, if financial markets cannot be righted quickly, the OMT will be launched by then as well. At that point, the entire world will realize the ECB has been bluffing about recovery all along, and subsequently asking themselves why on earth they just bought Greek sovereign bonds at multi-year low yields. And I wrote these notes yesterday on Thursday when this ridiculous, it was the first Greek sovereign bond auction in 3 or 4 years, and it was at these low yields, and I couldn't believe anyone would be buying them. And sure enough, as soon as it came out, yields have jumped up 35 basis points on that bond in one day. There's no doubt in my mind this was a propaganda scheme, that it was paid for completely by the ECB, the Fed, and whoever else was trying to promote confidence. And it's no different than the IPO of Ally Financial or Candy Crush, which immediately went in the tank. Or how about Twitter? Remember Twitter was $80 a few weeks ago? Everyone was all excited about that piece of garbage company. That's the biggest blight on this planet that I can remember. Down 50%. How about that in the last month? Twitter. Okay. So where are we? Yes, when the world's investment focus shifts back to the pigs, remember them? It will be catastrophic, as ultimately these profligate nations will either quit the euro voluntarily with their new anti-EU governments or be expelled. And remember, we have the European parliamentary elections next month, which should be very interesting. Subsequently, the return to national currencies will cause widespread hyperinflation and social unrest throughout Europe, without a doubt. Gee, I wonder how gold and silver will do in that environment. In the U.S., we learned that mortgage origination hit a 20-year low this week as Wall Street starts to flee its speculative Fed-funded investments, and the 99% have neither the jobs nor savings to afford new homes. Heck, JP Morgan's earnings were way below expectations today. Yes, JP Morgan that can say whatever they want. The FOMC minutes, which were released Thursday afternoon, revealed that indeed, as we expected, Whirlybird Janet was speaking off the cuff when she said zero interest rate policy could be ended as little as 6 months after QE ends. Not that I expect QE to ever end, but if so, the fact that many Fed governors are so fearful of rising rates from the zero level that they have been at for 6 years shows you just how terrified they are. I cannot emphasize enough that the article we wrote in early January, 3.0% enough said, is the most important we wrote all year. The Fed cannot allow Treasury rates the 10-year rate specifically, to rise above the key round number of 3% yield, which is why I loudly predicted a worse than expected NFP report last week amidst the fever pitch of post-winter weather economic recovery hype. Sure enough, rates have subsequently plunged from 2.8% to nearly 2.6%, and I see Bank of America warning that 2.4 could be coming soon. And given that we have never seen such powerful global treasury selling, you can bet that what we wrote in Proof of the Tapering Mirage, i.e. that the Fed is actually monetizing far more than it says, will soon be universally understood to be the truth. As for precious metals, the war with the cartel continues, as the very fate of billions of people lie in the balance. Ultimately, reality will win, as it always does. In the meantime, the paper market continues to be held well below the cost of production, yielding massive physical demand, as shown by the negative gold forward rates yet again, plummeting production, and likely the collapse of a significant portion of the global mining industry, which I believe will be permanent. Physical inventories from the COMEX to the LBMA, Shanghai Exchange, GLD ETF have never been lower, and imports into the East never larger. Fortunately, the force of supply and demand cannot be stopped, and in yesterday's article, Battlefield $20 Silver, I described how the culmination of bullish forces makes it essentially impossible for prices to materially decline from here, if at all. Ultimately, the $20 level the cartel has protected for the past 6 years will permanently fall, and eventually we'll see what I wrote an article a year or two ago called the ultimate quadruple top breakout, above $50 per ounce, en route to dramatically higher figures. Hopefully this podcast, and the plethora of horrific economic and political headlines the world around, I didn't even talk about the Ukraine this week, scares you into considering what if I'm right. If so, the time is now to protect your assets with real money. And if you do, we hope you'll call Miles Franklin at 800-822-8080 and just give us a chance to earn your business. Now more than ever, the fact that we have reached our 25th anniversary in business with an A+ Better Business Bureau rating, not a single registered customer complaint or a lost check, wire, or shipment ever, using a firm you can trust is of paramount importance. Have a good weekend. I'll talk to you next week.